Okay, so imagine this. You tell your investors you're going to triple your company's revenue. That's a massive billion-dollar bet. And for a company like Digitide Solutions, every single quarter is now a public test of that huge promise. So today, that's what we're going to do. We're going to break down their grand plan and see if the reality is actually matching up with the ambition. Let's get right into it.
So, this quote right here, this is basically where it all started. The CEO, Unit Chahal, making this public vow to hit $1 billion in revenue by 2031. Now, this isn't just some target they're aiming for. It's a fundamental reinvention of the entire company, and they announced it right after going public. Talk about pressure, right?
All right, so how are they actually planning to pull this off? Well, here's our game plan for today. First, we'll dig into the original blueprint. Then, we're going to check the latest progress report to see what's working and what's not. We'll dive into what they're calling the green shoots of growth, see how management held up under some really tough analyst questions, and finally, we'll map out the road ahead. Okay, let's start by rewinding the clock a bit, back to the company's very first earnings call as a public entity. This is where they really laid out the grand vision for the new independent Digitide Solutions. Now, the heart of their entire plan is something they call the 3x3x3 strategy. And, the best way to think about it is like this. They're moving from a giant serve everyone buffet to a carefully curated tasting menu. So instead of trying to be everything to everyone, they're zeroing in on 3 key industries in each region, and they're going to serve them with just 3 core services. It's a huge shift from being a jack of all trades to becoming a master of a very profitable few. And what's really key here, and kind of refreshing actually, is that management was super upfront about this whole thing. They warned investors from day one that fiscal year 26 would be a year of transition. That meant heavy investment in new talent and tech, and dropping some less profitable contracts. They basically said, hey, look, expect a short-term hit to our profits, but it's for the long-term gain. And that, of course, brings us to right now. The plan is in place, so let's look at the latest numbers from the second quarter of fiscal 26 and see if that short-term pain is starting to show any signs of that promised long-term gain. Yeah, this table right here, it really tells the whole story. Revenue is up a little bit, and the EBITDA margin, which is a really key way to measure profitability, is basically flat, just like they said it would be. But this is where it gets really interesting. Look at the share of revenue coming from their high-value tech and digital services and from international markets. Both are growing. This is the strategic shift happening right before our eyes.
So what does this all mean? Well, it shows the strategy is starting to work exactly where it's supposed to. They're successfully swapping out that lower quality revenue for more profitable, more strategic business. The foundation for that future growth is being laid, even if the headline numbers don't show a huge jump just yet. Right, so management has a term for these early positive signs. They're calling them green shoots. So let's zoom in and see exactly where this new strategy is starting to, sprout. First up, let's talk about the tech and digital part of the business. I mean, look at that jump. It surged by a pretty incredible 16% in just one quarter. Management says this is directly because of high demand for their new AI and digital transformation services, which, you guessed it, is exactly what their 3x3x3 plan is all about. And that kind of growth, it's already changing the company's DNA. The share of tech and digital revenue has climbed from 27% to 30% of the whole pie in just a few months. And make no mistake, this shift is absolutely critical because these are the higher margin services that are supposed to power their profits in the future. And get this, while all this internal reshuffling is going on, they are still out there winning big. We're talking over 500 crores in new contracts for the third quarter in a row. That tells you that customers are buying into this new direction. But a good story is one thing. Let's see how it holds up when the analysts start asking the really tough questions. Okay, so the numbers and the strategy, they sound pretty good on paper, right? But the earnings call, that's where the rubber meets the road. Financial analysts, they're paid to be skeptical. So let's see what they decided to poke holes in. And no surprise here, the number one concern was all about profit. The analysts really honed in on the fact that margins are down quite a bit from the previous year, and they wanted a clear timeline. They basically wanted to know, okay, when does this short-term pain you talked about actually end, and when do we see the gain? And you gotta give them credit, management's answer was pretty direct. They pointed to the fourth quarter of this fiscal year as the turning point for margins. I mean, that's a really specific promise. You can bet everyone will be watching that number very, very closely. But the analysts didn't stop there. They pushed for more clarity on that big long-term goal of a 2 to 3% increase in margins. That's what 200 to 300 basis points means. Management confirmed the target is still on, using the 14% margin from fiscal 25 as the starting point. But they were also really clear. Hey, don't expect this to happen overnight. And honestly, this is a huge takeaway. While they expect some improvement pretty soon, getting to their full margin target, well, that's a much longer-term project.
So how much longer are we talking? Well, fiscal year 2031, the exact same target year as their billion-dollar revenue goal. Yeah, this really just hammers home the point that this whole transformation, it's a marathon, not a sprint. The big payoff investors are waiting for is still many years down the road.
Okay, so now that we have a pretty clear picture of the plan, the progress, and the timeline, let's wrap up by looking at how exactly Digitide plans to get there and what could possibly get in their way. So, management has laid out this 5-point playbook for how they're going to get there. First up, they're going to keep pushing that shift into tech and digital. Next, they're looking to accelerate their international growth. Third, they want to use automation to get way more efficient. Fourth, they're going to be much more disciplined about the deals they take on, only the profitable ones. And fifth, they're focused on managing their cash more effectively. It's a solid, pretty logical plan. But, of course, it's not all smooth sailing. There are definitely risks here. A slowing U.S. economy could really hurt their international plans. A complex, multi-year plan like this is it's always risky to execute. They've also said about a third of their growth will come from buying other companies, and anyone who follows business knows that integrating new companies is, well, it's notoriously difficult. And finally, they're dealing with some weakness in their domestic financial services business that they need to get a handle on. And so, at the end of the day, we're left with this huge question. Digitide has a very clear plan, and they're hitting their early strategic milestones. But the full payoff is still years away, and the path is definitely filled with risks. The question for anyone watching this company is, is this planned turbulence just a temporary storm they have to fly through to get to clear skies? Or is this the first sign of a really long and really difficult climb ahead?